Welcome to the Deep Dive. We're here to cut through the noise, get straight to the point. Today we're jumping into something fascinating, really, the stock market. You hear these incredible stories, right? Someone turns maybe 5,000 rupees into a fortune, but then you also hear the opposite, people losing millions. It's quite the paradox. So the big question for this deep dive, is the stock market genuinely a way to build wealth? Or was it closer to, well, gambling?
That's exactly what we want to figure out today. Our mission here is to, look past the headlines, the hype. We need to unpack how it actually works. We want to show its real potential for creating long-term wealth and, importantly, give you the insights to approach it smartly, strategically.
Okay, let's unpack that right away then, because for a lot of people, the image is flashing lights, maybe people shouting on a trading floor. It feels very high stakes, almost like a casino. But then you talk to experienced investors, and they see it totally differently, as like a fundamental way to build wealth. So what's the real difference here?
Yeah, it's interesting how strong that casino image is, isn't it? But honestly, the reality, it's quite different from just speculation. When you buy shares, you're not just betting, you're actually buying a small piece, like ownership in a real company. Think about big names, maybe Tata, Reliance, Infosys, for example. Buying their stock means you own a fraction of that business. You have a claim on their future success, their profits. It's not just numbers on a screen, it's tied to real economic activity, real companies.
Okay, so it's about ownership, not just betting. But how does owning that tiny piece actually turn into serious money? What's the mechanism? How does that initial investment grow into something substantial over time?
Right. The absolute cornerstone is something often called the science of compounding. It's a powerful idea. Basically, your investment earns a return, okay? Then those returns start earning their own returns. It creates this snowball effect and accelerating growth. And what's really amazing is how it works even with relatively small amounts given time. So let's take an example, say 10,000 rupees. If that grows at, let's say, an average of 15% a year, which is historically achievable, though not guaranteed, of course, over 20 years, that initial 10,000 doesn't just add simple interest, no. It could potentially grow to over one like 63,000 rupees. But here's the real takeaway, the aha moment, if you will. The magic isn't about perfectly timing the market, buying low, selling high. That's incredibly hard, maybe impossible consistently. It's about spending time in the market, letting compounding do its work over years.
Time in the market, not timing the market. That really does sound like the secret sauce, but okay. Even understanding compounding, we know lots of people try investing, and well, it doesn't work out. They don't see that growth. What are the common mistakes? The traps that stop people from building wealth, even if they start with good intentions?
Yeah, there are definitely some common pitfalls, very common actually. First, there's this lure, this dream of getting rich quick. It's very strong. But the market really rewards patience and discipline, not frantic gambling. That's a big one. Second, a huge mistake is investing based just on tips. Maybe a friend tells you something or you see it on social media without doing your own homework, your own research. That's just dangerous. And third, maybe the most damaging emotionally and financially, is panic selling. When the market drops, fear takes over and people sell everything, often at the worst possible time. Think about the COVID crash back in early 2020. The market plunged. Lots of people panicked, sold their shares, locked in losses. But those who understood it's a long game, who were patient, maybe even bought more. They didn't just recover, they saw the market eventually double from those lows. Their patience paid off massively.
That resilience, holding on through the dips, yeah, that makes a lot of sense. So, okay, for someone listening now, maybe they're feeling inspired. They want to approach this strategically the right way. How do you actually get started? What are the practical first steps to build that bridge?
Right, starting smart is crucial. So step one is practical. You need a demat account. Think of it like a digital locker for your shares. Platforms like Zero, Grow, Upstocks, they make this pretty straightforward nowadays. Now, you'll hear about indices like the Nifty 50 or the Sensex. These are important, yes. They act like a thermometer for the market's health, showing the overall trend of India's biggest companies. Understanding what they represent is key. But for actually starting, I'd strongly recommend not jumping straight into picking individual stocks. That takes more expertise. Instead, consider starting with mutual funds or index funds. Why? Because they instantly give you diversification. You're buying a basket of stocks managed by a professional. It lowers risk, simplifies things. And another really smart move, invest consistently, a little bit every month. This is called a systematic investment plan, or SIP. The great thing about SIPs is something called rupee cost averaging. You automatically buy more shares when prices are low and fewer when they're high. It smooths out the bumps, but underpinning all of this, the absolute must-have, a long-term mindset.
Seriously, think 5, 10, even 20 years. That's the time frame where compounding really shows its power.
Okay, so the mechanics are clear. Demat account, maybe start with funds, SIPs, think long term. But what about, the mindset? Beyond the practical steps, it sounds like there's a big psychological part to this. Is it just about numbers, or is it like a mind game too?
Oh, absolutely. That's a really important point. What separates the consistently successful investors? A lot of it is psychology. Investing is as much about managing your own emotions as it is about managing your money. It's about discipline, sticking to your plan, especially when fear or greed are swirling around you, when the crowd is doing something else. There's that famous quote from Warren Buffett, probably the most successful investor ever. He said, "Be fearful when others are greedy, and greedy when others are fearful." What does that mean? It means having the courage to buy when things look bleak and everyone else is selling in panic, and having the caution to maybe hold back a bit when everyone's euphoric and prices seem too high. It's about that contrarian discipline.
Being fearful when others are greedy, greedy when others are fearful. Wow, that really hits home. It's about controlling those gut reactions. Okay, so wrapping up this deep dive, let's nail down those key takeaways. Remember, first, think like a business owner, because when you buy stock, that's what you are in a small way. Second, invest your savings, not money you need next month. Give yourself that stability. And maybe most importantly, give the market time. Patience is your best friend here. Compounding needs time. So the bottom line seems to be, the stock market isn't really a casino, not if you approach it right. It's more like a bridge you can build between where you are now and your financial future.
Exactly. It's a potential bridge. And the real question we leave you with is, are you ready to start building and walking on that bridge?
We really hope this deep dive has given you some clarity, maybe some confidence to think about that. And speaking of investment paths, next time, we're tackling another big question. Join us for our next deep dive where we'll dig into mutual funds versus stocks. Which is better? It's going to be a good one. Don't miss it.